I'm Chris Preston.
And I'm Brad Simmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network, which is saying something because Cabot Wealth has been around for 55 years and all the podcasts dating back during those 55 years. Really saying something. Brad, before we get to investing, which huge celebrity-ish death hit you harder this week? Ozzy Osbourne, Hulk Hogan.
Ozzy, I think, was expected. I don't think that was a surprise.
I mean, if you watched the his reality show, what, 20 years ago?
Yeah.
It didn't seem far off then. It was more amazing that he was still around, I guess.
Yeah, and Hogan took a real life heel turn towards the end there,
Yeah,
but Hogan was such a fixture in my childhood
same.
that I'm like, man, I didn't like he and I probably would not have gotten along, um, especially to the end in the end there, but
Yeah.
I do like I don't want to be in a world where Hulk Hogan doesn't exist. It
I
was
know.
critical for my childhood.
Yeah, the 8 to 11-year-olds, my 8 to 11-year-old self would have been absolutely heartbroken by this news. Yeah, I think he was probably the first name I knew once in the short period that I was into wrestling. Who doesn't know his name?
Yeah,
And
we had the
what's that?
figures.
I had the
Suburban
figures.
Commando was a weirdly I have a weird fondness for that movie, which was a Hulk Hogan movie in the
I think
sometime
I
in the
saw
80s,
that one. The
early
one I remember
90s.
is No Holds Barred, which I never saw, but I think it was supposed to be really bad.
And
Um,
Thunder Lips. Come on, he was in Rocky 3.
right, I knew that. Yes, yeah. Um, it's funny. Did you see the documentary on the Mr. McMahon documentary that came out like a year ago or so on Vince
I did
McMahon?
not.
Hogan, they talked to him a lot, present day. He seemed fine. So it's sort of shocking. He seemed like he was doing well. I know former wrestlers don't age well, and often don't age. So him lasting to
And
71 is probably longer than a lot of other former
with
wrestlers, pro wrestlers, but I don't know.
with
It
the
still sort of came out of nowhere.
Yeah, with the big guys, especially with like weightlifting guys, and especially if they may or may not have used steroids at some point, the heart goes, and it's like they can look
Yeah.
like the healthiest guys in the world, but ticker just sort of gives out. Uh,
Yeah.
so rest in peace, Hulk Hogan, and rest in peace, Ozzy.
Yeah. Yeah. To alliterative icons. Okay. Let's move on to investing. What are we going to talk about today?
So today we are going to be joined by Rich Howe of Stock Spinoff Investing a little bit later. And before we get there, we are going to talk about tariff news. We are going to talk about Tesla earnings, and we are going to talk about the return of meme stocks. Briefly, flash in the pan, but they're back.
Yeah, and for that, as always, we will start with our defend the take. And you're up this week, Brad. You have a very simple but profound take. That is that inflation is back. You have 90 seconds. Go.
Okay. So to lay the groundwork here, um, Tyler was on about a month ago, and we talked about I speculated, and he and I talked about whether the lower consumer spending, just because people are tightening up the purse strings a little bit, may have actually muted the impact of the tariffs on inflation. Essentially, if you're jacking up prices but nobody's buying your goods, that's not captured in inflation metrics, right? You can continue to sell old inventory. And I like that line of thinking, so I wanted to do a little bit more research on it and see if there's any actual indications that that's the case. So I was digging through some of the inflation numbers, and one of them that I was paying particular attention to was household furnishings and operations. So that includes stuff like small appliances, furniture, basically anything you need to furnish a household and then keep it running. There's also in household utilities and stuff like that are included in there. Um, and that was one that had been called out as maybe a canary in the coal mine for the total inflation story. In the June report, that was up 1% month over month, which was the highest since 2022 when inflation was really surging. So what I did is I pulled all the data, all the numbers for monthly changes in household furnishings and operations, and to normalize what can be some volatility on a month-over-month basis, I just took 3-month aggregate inflation for that metric. So looking back to the 1960s, essentially when the
Sorry.
data begins, dang it. All
I'll
right,
let you
hold on.
I'll let you finish.
I'm gonna
Yeah.
finish this thing.
Yeah.
So in the last 3 months, household furnishings and operations inflation has been over 2%. The only two times that has happened were in 2021 to 2022 when we were dealing with a ton of inflation, and then from 74 to 81, it was a regular occurrence, and that was the stagflationary period. So not a great, uh, not a great indicator there.
Yeah. I mean, you can see why the Fed has been reluctant to cut rates. No amount of hard hat wearing photo ops. We should have. I wish we had hard hats. We could have both worn them. That'd have been a great bit today. Um, no amount of that will, I don't think will force the Fed's hand. I still think they'll probably, well, it really depends on the data, I guess, the next inflation report in particular. Still think, they'll cut a couple times before the end of the year. But yeah, that last report is going in the wrong direction. I didn't take it as too much of an ominous sign, but um, that's good data. It shows that we should take the possibility of inflation coming back seriously.
Yeah, I think I know the Fed prices out food and energy as being too volatile because it is. This would be sort of like these would be like more along the lines of semi-durable goods where it's stuff that if it breaks, you need to replace it. You have to have a kitchen table, right? Like it's sort of unavoidable, and it's also a regular monthly input. I when I was sort of pitching this as a take, part of me was thinking that, this will be really evident in the upcoming inflation report, but I don't know if we're quite there yet. I think we are still working um, with the cost of goods that are working their way through the system. I was looking at some logistics at the logistics manager index, and they're seeing like really high inventory or really high costs upstream, but
Mhm.
that haven't reached downstream yet. So basically, stuff that's in the system is priced higher, but it hasn't gotten out to the final distribution level. So, maybe it's this report next week, maybe it's the one after, but I'm not going to be surprised if I see that the household furnishings item is high again. If it continues to be in the 1%, 0.8%, 1.25%, something like that, that does not really bode well. And then I think people start feeling that further into the third quarter.
Yeah. Yeah, PCE is next. Is it next Wednesday, Thursday, something like that?
It's the 31st, so
Next
that's
Thursday. Yeah.
Thursday. Yeah.
Okay. Well, that's something to keep an eye on. Let's move on to our big three. We'll start with tariffs. So speaking of deadlines, the August 1st deadline, we'll see how hard a deadline that is, that Trump has enacted. We're a week from that. Um, there's a headline just now on Yahoo Finance that it's 50-50. Trump put EU trade deal odds at 50-50. There has been some good news. A deal with deals with Indonesia, the Philippines, Japan. Although Japan, as that one's hit sort of a snag, is there's a disagreement about profits from a $550 billion investment in the U.S. No deal with Brazil, no deal with China, certainly. So it's sort of a mixed tariff bag now. Notably, stocks have continued to go up. People still don't seem too worried. We blew past the original July 9th expiration of the 90-day pause on tariffs. People didn't, with only a handful of deals, people didn't seem too concerned about that, probably because they knew that the deadline would be extended. Now it's August 1st. Maybe that'll be extended too. Yeah, people have, at least Wall Street has come to arrived at a believe it when we see it, I guess in a good way for the market sort of stance. We're not going to fear tariffs until you give us a real reason to fear them. Now, I mean, if it starts to seep into the data, as you sort of alluded to just now, then maybe that'll spark something. But as of now, tariff fears are not really raging on Wall Street, and stocks are at all-time highs as a result.
Yeah, I liked framing it as believe it when we'll see it. I think that very much is the case right now.
Yeah,
With Japan, they cut tariffs, and I think I had read some commentary from some hedge fund guys saying that the consensus is sort of like 15 to 17% is what they're looking at for an effective rate of tariffs. With Japan, they had initially set them at 30. They came to an agreement. There was some discrepancy over how much of an investment they're going to be backstopping or making in the U.S. The president said 550 billion, but supposedly that was the actual number was 400 billion, which was crossed out in black Sharpie, and then 550 was written in. So
yeah,
I don't know. I don't know if that's true. I don't know what the actual number is there.
yeah.
I don't know. I don't want to pay 15% more for everything, but if we're going to face blanket universal tariff, like what am I going to do about it? I can't, the US doesn't produce alternate goods. I'm just going to have to pay an extra 15%. And it is sort of very much part and parcel for sort of how this administration has operated with some things, which is whatever, people figure it out without maybe having a good plan in place. EU, I don't know, is EU going to be the last man standing? Right? Like they're at 30% now. Supposedly the deal is going to be for 15%. Um, it sort of demands somebody to call the president's bluff. He shouldn't
Yeah.
be able to unilaterally apply tariffs. That's not his authority, but he's doing it anyway. And is the EU going to call his bluff and maybe further undercut relations over a 15% tariff that we're going to pay because we don't have an alternate source of certain European goods? Like if I want champagne, just going to have to pay more for champagne. There's not there's nothing I could do about it. Um, so I think Wall Street is pricing it. It is pricing that in. Is these are going to be unavoidable. Nobody seems inclined to stop the president from doing it. So we're all just going to have to live with it, and hopefully consumers are okay.
Yeah, I mean, until the economy is doing so well or well enough that that has really contributed to, sort of the dousing the flames of the, tariff fears. While the latest inflation report was up and might be a yellow flag, um, corporate earnings continue to grow, with some exceptions, as we'll get to in just a minute. And, the economy is doing for retail sales are doing fine. Economy sort of continues to motor along. Now, like you said, if someone calls his bluff or if, some of these tariffs actually get, um, you know, fully enacted, that could change the calculus. And, I just think people need to see it before they believe it. And, um, initially I thought that fears of that July 9th deadline would have stocks sort of wallowing a bit the first week of July and maybe the last week of June, and that didn't really happen. So I don't think that August 1st deadline is going to have people shaking in their boots the next week either.
Hmm.
So tariffs are sort of like an intangible thing right now, that they're an existential threat, but you know, they become almost like, we talk a lot about how the Fed used to be the boogeyman, but like, the boogeyman is not a real thing. And the Fed was like the human version of that, when they had high rates. Now, this is like the fictional version, the actual boogeyman version where people don't believe in it.
Yeah, it does. I will give credit to, I guess, corporations in general, nobody in particular, but
Right.
in reviewing some of the the logistics managers index commentary, it does seem like a lot of retailers are doing what they can to sort of slow roll the additional costs coming from the tariffs. And part of that is by offering a lower inventory of goods at the sort of final destination. So instead of having the same wide range of goods available that are all, priced 15% higher or 10% higher or whatever, it's like, okay, well, no, we still have an excess of X, Y, and Z inventory, so we can furnish a lower availability of goods at a more reasonable price point. There's a boiling the frog element to it of it's going to result in this sort of taking longer to be fully priced in. But
Yeah.
I think everybody is sort of doing their best to avoid really hitting consumers hard and making this felt. I don't know. It's still probably too early to say whether the companies will be paying the tariffs, which is supposedly what the order from on high is. I don't expect that, but I don't know. Maybe they take a hit to margins a little bit, and maybe it ends up being less impactful. Yeah, framing it as like this ethereal boogeyman that is sort of overhead and lurking behind us at all times is certainly feels appropriate.
Yeah. Okay, let's move on to number two. I mentioned earnings, earnings season underway. Um, the big notable one this week was Tesla, which bombed
Yeah.
again. Revenue or sales, 12% decline. I think uh, in their cars only revenue was 16% decline, 16% profit decline. But the stock was knocked back, but not. It was down like 5-7%. Has actually bounced back some. They just rolled out. Musk keeps dangling the robo-taxi rollout as the next big thing that could be a game changer. And they are, they said that they're going to be rolling it out in San Francisco after they debuted it in, I think it was Austin, Texas. Um, so, but he even said on the earnings call, there could be some pain the next few quarters. Um, I don't know that this Tesla's like in its own bucket from the rest of the market because, it's so specific. A lot of the selling, a lot of the lack of sales, I should say, the last couple of quarters have everything to do with the person running the company. As there's been sort of a Tesla's backlash because of Musk's involvement in the Trump administration and Doge and everything. Um, I guess what's your takeaway from that or any other earnings report this week?
So for the on the Tesla front, the thing that stands out is regulatory credits. Um, they make a ton of money from regulatory credits because they produce whole home batteries and solar and EVs, et cetera, et cetera. That's gone with big the big bill. They actually reported 439 million in regulatory credits in the last quarter, which was down from 890 million the year before. That is what prompted Elon to say probably could have a few rough quarters.
Yeah.
Um, that's a huge hit because those are effectively costless for them. They don't
Yeah.
have any like they just do their business and then the federal government gives them regulatory credits. Um,
Why Musk was so critical of the big beautiful bill. Created
yeah.
a rift there. Yeah.
So that one comes right out of the bottom line because there's no input cost to it. They just lose it. So that comes right out of the bottom line. So that's going to make earnings look really bad coming up. I mean, unless they just have no regulatory credits whatsoever next quarter, and then you have a 4 quarters of bad year-over-year comps, but your quarter-over-quarter comps look a lot better.
Right.
Um, they also mentioned that the more affordable version, there was some discrepancy over how this is being reported. Apparently, in the earnings conversation or the presentation after, he was asked about the more affordable version and said, "What's it look like?" And he either said it's just a Model Y or it just looks like a Model Y. So it looks like their more affordable entry level version, which had been talked about over the years, like they talked about sub 25,000, sub 20. They've talked about different price points. It's apparently just going to be a stripped down like lower priced Model Y. I have serious questions about whether robo about how well robotaxi is going to work if it's
Yeah.
broadly deployed, not from a technical standpoint, just from a humanity standpoint. Do you remember a couple of years ago when some researcher was trying to send a robot across country? Do you remember that at
I
all?
think I vaguely do. Yeah.
It it got to Philly and then it got defaced to death, essentially. Um, I wonder if you have a widespread robotaxi rollout with no oversight, right? Like the goal isn't to have somebody babysitting the car and sitting in it for every ride. It doesn't do any good. Once you pull out the minders, the people that are in the cars while they test, people are just going to destroy it. People are going to be putting out like cigarettes on the seats and throwing up and damaging. I think like the American public is just going to destroy robotaxis and they'll end up being a really high cost and potentially low quality experience for people.
Yeah.
I don't know. Maybe that's just my lack of faith in humanity coming
I mean,
through,
I
but
think Waymos are, everywhere in LA. I don't know how much defacing's going on there. But people also
yeah.
don't know the owner of Waymo probably.
There's also the sort of early adopter element. Like the people that are taking the Waymos now are the ones that are interested in doing it because of the tech, I presume. I don't know. It hasn't rolled out to my area of Phoenix. There are some in Phoenix.
There
That's
are
just
some in Phoenix. Yeah, we don't have any here, I don't think.
yeah, in the like the downtown Phoenix area, but I'm a little bit out in the burbs. So I don't know. My faith in humanity is not as strong as it's ever been right now. So I think maybe that's coming through. But I don't be surprised. I would say don't be surprised if these sort of operational costs of these robotaxis, whether it's for Tesla or Google's Waymo, if they end up coming in higher than everybody's expecting.
Yeah.
So
And as for Tesla stock, I've mentioned this that in my stock of the week newsletter. It's been in there for since long before I took over the newsletter. I was spotted by Mike Santolo in December 2011 in Cabot Top 10 Trader. And it's been in the portfolio since then. So the return is, north of 18,000%. Longtime Cabot subscribers have built houses on their Tesla profits, bought Teslas on their Tesla profits. Um, and every time I'm like, okay, but would I buy it now? Would I buy it at these levels? I think the answer still right now is yes, because it's trading right around 314, 315. It's well above the lows from earlier this year, which was in like,
220-ish.
yeah, 220. To get to the closing low was 221 in April, of course. The high, not too long before that, was in December, 479 closing high, roughly 480. So it's sort of in the middle, I guess, closer to the lower end of that range. Do I think it can get back into the 400s? I do. But I could see, I'm going to treat that December high as basically a intermediate to maybe even long-term top. If it ever gets close to that again, for whatever reason, robo-taxis, maybe the bar will be set so low on earnings that, if it clears that low bar once or twice, that could really goose the share price. If it ever gets close to that December high again, I really might consider finally 14 years later recommending selling. But, things like a cockroach, you can't kill it. I think, and I don't want to compare Tesla to a cockroach. It's very good cars. But yeah, I think it still has. I'm sure there's some sort of catalyst that could drive it to higher prices from here, even in the next month or so.
Yeah.
So yeah,
So the Department of Defense signed an agreement to use their Grok model,
yeah,
um, which has a mixed track record, led to the resignation of X slash Twitter's CEO recently, for reasons that I can't really discuss on this podcast. But if you're interested, you can find that out yourself. But like, okay, what if that's the government's go-to AI model? Yeah, absolutely. Tesla could hit 400. I think the way to approach Tesla, especially if you're a long-term shareholder, put a downside target. Like, look, if it breaks this level, I'm out. Um, and then maybe put an upside target. And if it breaks that level, I'm going to take profits and get out. And if it does anything in between those two, you just ignore it.
Yeah.
It's a nonsense stock to to a degree. They're not priced like a car company. They have a social media arm. They have space, right? Like Musk obviously runs SpaceX,
Yeah.
but Tesla doesn't own it. Same thing with like XAI. The legion of fans that it has causes it to behave irrationally. Like there's so many sort of open questions and uncertainty around it. I think you set hard limits for when you get out to the upside and to the downside, and you sort of ignore the noise.
Yeah.
But I mean, that's coming from a guy who does not own Tesla stock. So
Yeah. Okay, let's get to our last item. Again, nonsense stocks. These are actually more fit that definition. So there's a new round of meme stocks, I guess you could call them, that have popped up in the last week in particular, extending back until earlier in July. Those include Open Door in particular. That was the first one. It's up 380% in the last month. Um, and that is a e-commerce company. Kohl's department store chain up 58% in the last month, and as high as I think it was 37.6% in one day earlier this week. Um, Krispy Kreme 62% in the last month. GoPro 64% in the last month. 100 Flowers 26%. Beyond Meat 14%. Basically, all the most highly shorted stocks have been getting short squeezed. And there's a movement behind them, similar to the one we saw early 2021. Maybe not the same. It's not the same sort of force that we saw there. And we have seen temporary meme stock runs sort of pop up from time to time in the last few years since. I wrote this week that I think it's a red flag for the market. Anytime you get meme stocks, at least since they became a thing 4 years ago, it sort of signals that to me that we're reaching at least a temporary top. What do you take from the latest meme stock craze or semi craze?
it sort of reeks of desperation. It
Yeah,
sort of reeks of all right, like Nvidia is doing well, all these big tech companies are doing well, but they're not killing it. So it's like the most extreme edge of people just trying to juice returns however they can find it. The thing that stood out about Open Door, it was so GameStop was grassroots, right? One analyst who's like, "Hey, this shouldn't be valued this way. It's overshorted. It's overshorted so much that there might not be enough stock. I'm going to start telling people about it." And then it took off. It spread. Grassroots was effective. It took off. Did really well. Made a bunch of people a lot of money. Cost a lot of people a lot of money. Um, if that was grassroots, Open Door is AstroTurf,
yeah,
right, where it's artificially constructed. The guy behind it is a Canadian hedge fund manager by the name of Eric Jackson. He's been shilling this $82 price target on Open Door. Um, the thing about Open Door is it doesn't have that short catalyst. Um, it was like 24% short, so not one of the most shorted stocks in the market in that instance. And when he's pumping the stock up, he's saying, okay, well, you got to look at like enterprise value to sales. Well, Open Door sells houses. Um, if you're selling a $500,000 house, that makes it look like you have a $500,000 in sales, and
yeah,
your costs are through the roof because you're buying houses. So it's fake. There's nothing behind the Open Door run. It was one hedge fund guy whose hedge fund supposedly lost a lot of money, who has been sort of engineering this on Twitter, on X, on social media for the last several months. I you know Okay, I will say all of this is allegedly. I haven't talked to the guy. I don't know what his thought process is, but just looking at it from what I can see in publicly available information, it's not heavily shorted. There's no reason for it to be doing this. And it has been sort of panning out that way. It took off for a couple of days on investor hype, and then Open Door settled down a lot. Same thing with Kohl's Donut. DNUT, which is Krispy Kreme, and then
Hmm.
Rocket Companies, which is Rocket Mortgage, was another one that was up 22%.
Yep.
I've seen a few people call it the dork trade, which I like a little bit. It's fun,
Yeah.
but these are not. This has like all the yellow flags of the meme stock mania, but without that silver lining of individual investors trying to beat the market and beat the big guys and beat the institutions and seeing this level of exploitation in excess shorts. So this is all the bad without any of the good, which stinks.
Yeah. I mean, I guess regardless of, motivations behind it, it feels like the type of thing. Now, again, we've seen pushes on, like Jacob often, our options expert would be like, we're seeing some potential meme stocks pop up and reel off what they are. Usually they're pretty short lived and nothing's coming, he said, watch out, this could be a red flag for the market. And a couple times in the last couple of years, it hasn't been, but this feels like has a little bit more force and has, sort of made headlines a little bit more than some of the others. In the past, Jacob's looking at unusual options activity and he's sort of seeing things happening under the surface that may not, show up on the front page or not front page, but on the Wall Street Journal or on Yahoo Finance or wherever. And this has, does it definitely mean that we're headed? I mean, I've said I think that a pullback is coming in the next couple of months, probably by the first week of September, as it usually does when everyone returns from their summer vacations, usually right after Labor Day. But I don't know that this will necessarily trigger something prior to that. But I do think it's one more, it can lump in Bitcoin at all-time highs with this and this market at all-time highs, despite everything going on. One more sort of yellow to red flag that market's feeling a little frothy and toppy right now.
Yeah. Yeah, I think that's a good takeaway. Do you remember what the meme stock angle was in like 23, 24? Like I don't think it was GameStop again. I think it was something else that popped in. I'm drawing a blank on what it was at the time.
Yeah. I mean, I think the fact that we can't remember them means it was kind of minor.
Yeah.
Um, we probably never even talked about it. I remember maybe Jacob said it like on here around then. I did GameStop has popped up at times. But yeah, you're right. There were some others. I can't remember which
I,
which one it was right now.
I like GameStop's business model is now, I guess, buying Bitcoin. Like I don't know. This I think it was
Good
Charlie
synergy.
Munger. Uh it might have been Buffett. One of them classified Bitcoin as being wretched excess.
Hmm.
And I think this level of like meme stock visibility definitely falls in that wretched excess category,
Yeah.
which I think anytime you can apply that to like an investing trend, it is probably a top signal or the beginnings of one.
Yeah. Yeah. So definitely something to keep an eye on. I imagine they'll pull back, you know, what they've gained in the last week to two or three. That they'll come crashing back. If I don't know if they'll lose all their gains, but regardless, I think it is, even though it's been temporary, I think it is a warning sign. Okay, so let's get to our guests just a second. First, I want to tell everyone about our offer today. If you go to cabotwealth.com/street, we are offering uh, Tom Hutchinson's Cabot Income Advisor for 50% off the normal price. That's $397 for the year. You get a 30-day, 100% money back guarantee if you want to try it out for 30 days. It is a monthly advisory. Excuse me, there's monthly issues, but there's weekly updates. And it's not only dividends paying stocks, but also covered calls are a big part of his portfolio. Covered calls to on the stocks that he already owns in the portfolio to sort of create a steady flow of income for subscribers. You get access to Tom, who's been on this podcast several times, You get a free report. The covered call income machine explains sort of his covered call strategy. And again, it's for today's listeners. You get 50% off the normal price just by going to cabotwealth.com/street. That's Cabot Income Advisor for half the normal price. Okay, let's get to our guest for today, Rich Howe of stockspinoffinvesting.com. All right, welcome in Rich Howe, former Cabot analyst, and now runs his own site, stockspinoffinvesting.com. Rich, welcome. Good to see you. Been a while. Used to be a regular here, so we miss you. But one of the reasons we wanted to have you on, we don't talk microcaps a ton here or spinoffs, so we'll get to both. I don't know the answer to this myself, or I gave it a glance earlier this morning, but microcaps, how have they done so far this year? I know small caps have lagged. Have microcaps been in a similar position? It looks like they've rallied a fair amount since the April, pullback.
Yeah, exactly. So it's been I was looking at the chart this morning, and there's not really a great index that tracks Russell cap or micro caps, but I'd say the best one is probably the Russell microcap index. And
Yep.
it has rallied sharply, from the bottoms of Liberation Day. I would say, like, if you look back, the microcap market, defined as like the Russell microcap index, is not at an all-time high, which obviously the S&P is at an all-time high. So it continues to lag the larger market, but there are stocks that are doing well. It's recovered nicely from Liberation Day. But I'd say large caps and mega caps are still leading the way, as you guys probably know.
Had that index been lagging for the last couple of years the way that small caps have been, where it's almost been like a historical underperformance?
Definitely, yeah. So it's been a historical underperformance. The other tricky thing with the Russell microcap index is that it's geared towards some of the more liquid microcap names, and so so you have some. I guess it's not the best representative index of how what opportunities are available in microcaps. Like, some of them that are smaller and don't have much liquidity may be a little bit more attractive, but there's not really a good way to track those. But yeah, you're exactly right. The Russell microcap index has definitely lagged, similar to small cap stocks. And it's been kind of the continuation of a trend. I always am like, okay, a value is going to come back at some point, or international is going to come back at some point. I think international is starting to come back,
Yeah.
but it seems like we're still waiting for value and microcaps to come back and get in the market's favor.
Yeah, I'm curious if you have any, maybe a specific perspective on why that might be the case. Small caps, microcaps have always been associated with like a risk on mode for the market. And we're certainly seeing evidence of other risk on assets flying. So, speculative meme stocks, cryptocurrency, like all this stuff that sort of went hand in hand leading up to and then into the 2021 bubble. Do you have any idea of what might be behind that disconnect?
I really don't. I mean, it's tough to know with any certainty. I would say, I mean, I think once Liberation Day started, or we were heading into Liberation Day, and it looked like there was going to be tariffs like all over the place. It seemed like for once that the large cap and the mega caps were going to get absolutely crushed, and it seemed like some of the smaller caps and more domestic oriented names would actually be better positioned just because they have more of a supply chain based in the United States. And so it seemed to me, I thought that was going to be a nice opportunity, and maybe this is going to be a big rotation out of the large and mega caps into the small caps. But that really, as we've all seen, has not been the case. So it's really tricky to say. I mean, some people will say that the period where small cap stocks are going to outperform is just it's an anomaly, and it's never going to happen again, because the quality of the large and mega cap stocks is so high that, like, why would you ever invest in a small cap? And there's a reason why they're underperforming. And there's a lot of intelligent rationale for why the small cap stocks are kind of continuing to lag. But I just, tend to think that these things go in cycles, and it's been, 10 plus years of kind of large and mega cap stocks really, really leading. And so, I don't know exactly like what is going to be the catalyst, but I think at some point it will turn, and we'll probably have like a nice, 5, 10, hopefully 15-year run where small and micro caps have a good run. But it's really hard to put your finger on exactly, what's driving the continued dominance really of the large and mega caps.
Are there particular sectors or even names in the microcap space right now that you really like?
Yeah, so two names that I actually want to talk about are two names that I actually recommended when I was back at Cabot running the microcap newsletter. And one is a company called IDT Corp, ticker is IDT, and it's actually not even really a microcap really anymore. It's got about $1 billion market cap, but that's a name that is basically a spin-off machine. So what I really like about it is that it has a really good management team that's run the business for a very long time, and it's kind of a conglomerate. But what they do is once one of the underlying businesses is performing really well or justifies having its own listing, they will spin out shares of the new company to investors. And so it's kind of like an anti-conglomerate. And so that's one business that has three underlying businesses that are doing really well. Probably the most exciting of those businesses is a business called NRS, which is basically like a terminal business that allows bodegas and other convenience stores to have a terminal where people can swipe their credit card. And this system can also do a lot of things like show advertising. It can also better help the individual convenience stores better manage inventories and run sales and track inventory levels, and also do some advertising. So that's one of the underlying businesses that's really growing very well for IDT. But they also have two other underlying businesses that are really fast growing. And eventually, the cool thing about IDT is usually IDT is very good about spinning off its underlying high growth subsidiary. So it hasn't happened in a while, but I think since inception, IDT's done like 5 or 6 individual spinoffs, which is a nice way to crystallize value. And then another name that I like that Cabot Microcap Insider subscribers might remember is a name called Medexus. Now, this is a specialty
I
pharma
remember it
name,
well.
which you edited a bunch of my write-ups on Medexus, and this one has not done as well as Medexus. Medexus is up, about 200% in the past 3 years or so. So that one's doing great. Medexus is not has not done as well, but it has a lot of catalysts that have played out. So they got a new drug called triosulfan, which was approved. Medexus currently has about $100 million of sales. This drug by itself has a potential to generate an additional $100 million of sales. And it's very high margin. It's much higher margin than all of Medexus's other drugs. And so the catalyst has kind of arrived, but Medexus has not really, the stock has not really re-rated much higher. It's done fine, but it hasn't re-rated as high as I thought it would. The stock still trades very cheaply. It trades at like 5 times EBITDA and about 4 times free cash flow. And I think sales will probably double over the next 3 years. So I think that one is a name that hasn't worked out, but I still own it. It's actually, full disclaimer, it's my biggest position. Not to say that is, that it's necessarily going to work out, but it's a name that I do continue to have some pretty high conviction in.
I'm curious about IDT. Are they doing acquisitions and then nurturing and then spinning out, or are they founding internally? What's their process?
Yeah, great question. So it's really founding internally. So all these underlying businesses that they've started, they basically incubate and grow from scratch, and then ultimately spin those businesses out. So this NRS, this kind of terminal business, which is in convenience stores, that's a business that they completely grew from scratch. They're mainly known, their like legacy business is in wireless calling and money transfers, and they really cater to immigrants. But the paid business for making phone calls to other countries is, by definition, really in secular decline, right? You can use the internet, calling is basically free these days. So they basically milk the cash flow that they've generated from this other legacy business and used it to invest in other businesses and really build these businesses from the ground up. So it's really been they'll make, small little acquisitions here and there, but generally it's an organic story where they've really built these underlying segments from scratch, and then ultimately their history has been to spin them out.
And so obviously a lot of your attention, as the name of your website suggests, is spin-offs these days. Are there any spin-offs that where you spot opportunity right now?
Yeah, so I like to look at, obviously, I love to cover spinoffs. And, one of my favorite situations is when a spinoff is indiscriminately sold. So, when you own a stock that's going to spin off the subsidiary, whether or not you want that subsidiary, you're going to receive that subsidiary. And so the most likely outcome for most investors is to like say, hey, why did I receive this other security that I know nothing about? So I'm just going to go ahead and sell that new security that I've received. So I think the best situations are those. I love when there's like a situation where there's indiscriminate selling pressure, that you can pick up stocks that have sold off. But then other times, sometimes the parent company is what I think is more attractive. And so, usually I like to look at small companies and micro caps, like we were talking about earlier. But one company that I think is really interesting and is not a small company and is not even a spinoff. It's the parent company. So Western Digital recently spun out their flash division, SanDisk, and I think SanDisk is pretty interesting in its own right. But Western Digital, the RemainCo, I think is pretty interesting. That one is focused on hard drive memory, and hard drive memory is, it's very cheap. It's pretty inexpensive to buy, and you don't really think that you need much hard drive revenue because you want faster performing memory like flash and in other sub specialties of memory. But with the increased consumption of data, right? The increased consumption of data, that's not going away. ChatGPT and AI is continuing to generate more and more and more data, and there's really a market for hard drive data, especially in data centers, for information that doesn't need to be accessed very quickly. And so the growth and the demand for hard drive data or hard drive storage devices, which Seagate and Western Digital make, has really been growing very nicely. But it's a nice oligopoly market where both of them control about 40% of the market. And so that's a RemainCo. They spun off SanDisk, their flash business that I like a lot. That one trades at it's done well. It sold off like crazy, during the tariff, situation earlier in April, but it's come roaring back. But despite that, it trades at like 13 times EBITDA versus versus Seagate at about 18 times. They're right at their net leverage target. So I think when they report earnings, they're most likely going to announce either a buyback program or an increased dividend. And that's not a small stock, but I think there's a really nice secular outlook for that story. And it benefits from all the things that, all the high flying tech companies benefit from in the AI space. Tons of new data is being created by AI, but it doesn't trade at like the crazy multiples that a lot of these other, high flyers trade at. So that's one, I'd say, RemainCo that I like. And then another name that I like that's a spinoff, a more traditional spinoff, is a company called Lionsgate Studios, which is behind many movie franchises like Hunger Games and Saw and John Wick. And that, I think, is a scarce asset. So I think it's only going to be a matter of time before somebody scoops up that asset, because there's a limited number of premier studios. And that one's really kind of sold off, similar to what you typically see with indiscriminate selling that happens with most spinoffs. So that's one spinoff that I think looks pretty attractive.
When was Lionsgate spun off? Do you know off the top of your head?
Yeah, so it was a couple months ago, so it's very recent. And the difference, so what happened was this basically undid a transaction where Lionsgate years ago, they bought basically Stars, which is a pay as you like kind of like an HBO type
Yeah.
product. And they ended up, spending I think 2.5 or $3 billion for that asset. And then they ultimately it was a bad asset. It was a bad purchase. They were kind of diversifying away from being a studio, and the basically the Stars business was very tied to linear TV. So you would buy a linear TV bundle, and oftentimes it'd be bundled with like, an HBO subscription or a Stars subscription. And I think like 70% of subscribers for Stars came from linear TV. And so over the past 4 or 5 years, it's been a big headwind for Lionsgate Entertainment, this Stars business. That Stars business has actually looks like it's kind of stabilized, and I think it's pretty interesting in its own right. It's considered the RemainCo in this situation, but it has a very small market cap. It's only like a 300 or 400 million market cap. But what they did was they separated the Lionsgate Studio from RemainCo Stars. And the other interesting dynamic here is that it was a taxable transaction. So most spinoffs are not are tax free. And what that means is there's usually a 2-year prohibition from the spun off entity being acquired. But in the case of if it's a taxable transaction, there's no 2-year window that you have to wait for. And so that's pretty interesting. And then the other interesting dynamic here is that Steve Mnuchin, who runs, I think 77 Capital, I think is the name of his firm, but he's just been buying Lionsgate Entertainment hand over fist. He's up to about 15%. He's a pretty good investor, a pretty good activist. And then there are already rumors that there's another studio called Legendary, that's Apollo backed, has, potentially wants to buy Lionsgate. So I think, I don't know if it's, within the next 3 or 6 months, but I think 2 years down the road, I think there's a pretty good probability that Lionsgate is acquired either by like one of the big tech players or by a PE backed company.
That
Looking at
definitely
the
sounds like
market,
one for the watch list.
For
yeah,
sure.
sure. Looking at the market just from the 10,000 foot view, because I know you're good on sort of taking the market's temperature. What with stocks, at least the large cap indexes at all time highs. Are you concerned at all? I know you sort of take a value approach, but where do you see things going the next few months in terms of the market?
Yeah, so I know I think we all follow Ryan Dietrich, at least I do on
Yes.
Twitter, and
Yeah.
he's always good. I mean, he's great, and he's almost a contrarian in that he argues that like when, strength usually begets more strength,
Right. And so
right?
does Mike Santola. Mike Santola follows the same thing here. Yeah.
Totally. And
Yeah.
it's like, hey, this is actually a good thing. It's a sign of market health. So I'm definitely I'm more of a contrarian, I would say, but I need to remind myself that, hey, like if you just bought at all-time highs, you would probably do really well.
Yeah.
But at the same time, I'm a little bit cautious. Like I like to I don't want to fight the trend or fight the tape per se. But I'm looking for like the nice thing about spinoffs or other situations that I invest in is usually there's like a hard catalyst. So like there's an idea that I own and I'm recommending called Net Lease Office Properties. And it was a spinoff, but it's also a liquidation. And they basically own a bunch of like legacy office assets. But they basically have paid off all their recourse debt. They're selling assets much above where the current equity value is implying the assets are worth. And then this company is going to start out paying distributions, over the next, it could be, over the next couple months, over the next couple quarters. And so like a name like that, I like a lot because I think on an absolute basis, we could get like a 40 to 50% return over the next 2 years. And I think that would stack up really well, even if the market continues to do well. But if we do see a hiccup and the market does pull back, I still think a name like this could generate kind of that, 40 to 50% over a couple of years, which would be really good on a relative basis. And so like, I guess I'm cautious, but I want to make sure that I that I don't that I'm not overly cautious and kind of like a
Yeah.
perma bear, right?
Not preemptively sell anything just because stocks are at highs. And yeah. Yeah. Brad,
Exactly.
did you have anything before we let Rich go?
No, no. I think that has been instructive. I am definitely writing down Lionsgate. And
Yeah,
if you're
I wrote that
listening,
down too.
keep an eye on that one. Although, I mean, like obviously Hollywood is complicated environment right now. I mean, I know Paramount is what they just were spun out from, or no, they are going through the merger with Skydance. So there, it seems to be a lot of M&A activity out there and potentially higher risk. But thank you for
Yeah, and
that
I
insight.
think it's in one of the comps, like in terms of my valuation, I'm kind of saying because like a lot of the comps, like Amazon bought MGM in 2021, and people argue, well, that was like a bubble purchase, like Amazon, maybe they overpaid for that. But like what I'm like my fair value for Lionsgate is basically the Skydance Paramount transaction. Because basically what's happening, Skydance is a studio, and effectively they're kind of merging with Paramount. Um, and and you can kind of back into what the pro forma valuation of Skydance is. And Skydance is probably a worse asset than Lionsgate. Lionsgate has almost $1 billion of revenue of library revenue that they get from streaming assets. And so, like, kind of my base case valuation for Lionsgate is it's probably worth what Skydance is worth, at least on a kind of like a revenue basis or an EBITDA basis. And if you value it that way, then Lionsgate's worth, call it 11, 12, $12 or higher. And so, yeah. And then the other messy thing is like, if you just look at the financials for Lionsgate, it's like pretty messy. And so you got to be comfortable that it's like this is kind of a scarce asset that people really really covet and that is valuable. And then the other thing that I like about it is that there's a lot of potential buyers. Like you could have like a large cap tech company, right? Like Google or Amazon or Apple. Like wouldn't shock me at all for them to spend $5 billion on Lionsgate. But you could also there's a lot of interest from private equity. Like there were rumors recently that Apollo's, they back a studio called Legendary. It looks like they're interested in merging with Lionsgate. So it seems like there's a lot of ways to win. And then you have the activist involvement. And then the other interesting thing is that Lionsgate used to have a dual class share structure. So it used to have A shares and B shares. They got rid of that with this recent transaction. So it just makes them much more, it makes it much more likely that there could be a transaction where Lionsgate gets taken out.
Rich, thanks for joining us. Great stuff as always. Great to see you. Hopefully you're getting through the summer with young kids at home. Hopefully you have enough camps to hold you over and allow yourself to enjoy the summer a bit. So stockspinoffinvesting.com. Anything else you wanted to plug or anything anywhere else people can find you?
No, yeah, just check me out, stockspinoffinvesting.com. I'm also on Twitter under @stockspinoffs, or just search for, Rich Howe stock spinoffs and I should pop up. But yeah, if you want to chat, please reach out.
Great. Well, thanks again. Thanks everyone for joining us on this week's edition of Street Check. We'll be back next week.